Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy.
Darin, so thank you so much for joining the What the Finance podcast today. I'd just like to start by asking what is your investment philosophy?
Yeah, Tuttle Ventures is a firm that I just started. We're 3 months old now. We have, I think, a very unique approach. We take a fundamental value equity strategy, primarily based in the US, and we overlay that with a relative volatility strategy. So we have a combination of just basic fundamental investing, right? That's a tried and true method. And then we overlay with that some statistical properties and trading volatility as an asset class to be able to drive superior returns.
Yeah, interesting. So it's the balance between obviously that quantitative based stuff and then the fundamental as well.
Well, certainly. And I think, anybody that's investing in a general sense, whether it's a derivative or whether it's a company or a real asset or something tangible, those business principles, right, still apply and are tried and true methods. So
yeah, definitely. And so you started your finance career at sort of Goldman Sachs, and then can you talk about sort of working there, your journey afterwards? And you mentioned Tuttle Ventures there, if you can go on about that as well.
Yeah, certainly. So I got my start in the operations division of Goldman Sachs, specifically for securities lending. So I worked with the supply side desk to be able to short shares for counterparties that wanted to take concentrated short positions in the market. If you remember Blockbuster, right? To be able to short those shares legally, you have to be able to issue a locate to satisfy Reg T requirements. And so we had a desk that was set up, and we had a very small knit group of maybe 5 or 6 different counterparties with all the big banks to be able to source the shares that you needed to be able to locate or cover your short positions. And so that's where I got my start. From there, the systems that we were using required a lot of technical expertise. And because of that, I really stood out as a subject matter expert. And so they actually moved me to the prop trading desk and help onboard clients onto their proprietary trading or electronic trading networks. So I would help hedge funds get transitioned onto Goldman's proprietary trading networks, set them up with all the algos that they would need, all the exchanges that they would need, make sure that none of the traders were making fat finger mistakes. And because of that, I was kind of put in a very unique approach. I was still, entry level, risk analyst, financial analyst position. But then I'd have to explain to a portfolio manager why he's not able to implement that strategy in lean hog futures, right? So I was able to see, from a unique perspective, how many different portfolio managers constructed their portfolios from an operational standpoint, right? And because of that, I knew that I wanted to, going forward, have a risk, forward management approach, a risk factor-based approach to investing and to managing portfolios going forward.
Yeah, it's interesting. So obviously you started in the helping other people actually, do their trades, and then you wanted to do it the other way. So you actually wanted to sort of be on the buyer side of things.
Right. And I think, every investor has a unique experience that leads them to investing, right? And I think it's also, really important to have your own strategy to investing, because when times get tough, or you start to question your individual investment strategy, having that thesis, that core thesis that's based on your unique experiences, allows you to be able to stick with it when times can get hard. Have that vision, that courage, and that patience that successful investing requires.
Yeah, definitely. And can you go more into sort of your strategy to maybe even finding companies and then what you do from there?
Yeah, certainly. So, I think one thing is important is when you're looking at a map, right? And then you want to say, okay, like, where are we now? And then be able to kind of draw back from that to, how a fundamental equity value strategy is constructed and how a volatility overlay enhances returns there. So if you look at, the US or the S&P 500 as kind of a benchmark, you're looking at a forward price to earnings right now of around 21, right? As opposed to the 25-year average of 16. If you use, Shiller's price to earnings ratio, we're at 38 compared to the 25-year average of 27. When you drill down a little bit more, right, because the devil's in the details, I love going into the details. If you look at price to cash flow and price to book, right? These are primarily more value driven metrics to be able to look at the market. Price to cash flow is trading at 16, while price to book is trading at 4. And you also compare those back to their 25-year averages. Price to book is usually trading at 3 times. Price to cash flow is usually 10 or 11 times. So you're looking at these price to cash flow being inherently more expensive now. People are willing to pay more for that immediate cash flow than what's actually on a company's book at any one point in time.
Yeah, it's interesting. Would you say that's maybe linked to sort of the monetary and fiscal policies that's occurred, and maybe people think there's less risk involved in these companies?
Yeah. So why value, right? Value, in a sense, has a shorter duration, right? Because the determinative value of your cash flows is typically already priced into that company, right? They are able to have that cash on hand from somewhere, right? Where you're determining what that fair value is or that intrinsic value is going to be. When you look at different interest rate regimes, right? Typically falling rates disproportionately, help growth stocks, right, from the traditional measure compared to value stocks. And so as we've seen rates continuously fall over the last 30 years, there's been a multiple expansion in growth stocks relative to value stocks, I think by like 80% or some ridiculous number like that. So from 2015 onwards, the multiple expansion for growth stocks has seen significant growth, while value has just been beaten up along the way. However, if there's an interest rate regime change where interest rates begin to trend upward, then you're going to see that shift in the expansion multiples fall back into favor for value.
Yeah, definitely. We're sort of seeing that at the moment with there's the argument obviously over transitory inflation and actual inflation. And I think most, it seems like it's like some people are for each, either or. So what's your sort of opinion on inflation? And I guess, as you said, if it isn't transitory and it's more long-term, it would obviously benefit the value companies compared to the growth.
Certainly. So, I don't think my opinion really matters. But I do think that, risk cannot be eliminated, only transferred. So, what I mean by that is, there's the law of large numbers, right? So I can't say what one individual is going to do on an individual basis, whether they're going to charge more for services or not, right? But what we can say is, in the longer term, 1 million people making independent decisions, all across the world, we can kind of make inferences or have statistical order to that behavior going forward. And what the large numbers is telling is that prices are going to increase, and it may not be as transitory as the Fed maybe implies. When you talk about transitory timeframes, are we talking about 3 months? 6 months, a year, 2 years. Powell's latest comments infer that transitory, by his definition, is on a 1 year or longer time frame, which may be a different definition or time frame than you or I put at it, right?
Yeah, and it's quite interesting because we've seen sort of CPI this week running very hot. And I think an interesting part of that was shelter. I'm not sure if you've sort of looked at the stats. I think it was 2.5%. And that's something that we normally see is quite sticky compared to vehicle and energy and stuff. So I guess.
Yeah. What was it at? I think it was like above 5, right?
Yeah, I don't think it was that. I think it was about 2.5 or 2.6, but still it was only over 5 months. So as you see, it's probably 5% over the last year, which is extremely high. And it's something that they say that it's not transitory. It's often, if it goes up, it stays there, doesn't it?
Yeah. It's I think also, you look at like the pricing mechanisms for things like autos, right? I think autos made up a significant portion of the price increase. I don't know what the exact number was. Maybe it was around like year over year, auto used car sales, right? Auto has significantly increased. And one of the trends that I've seen is that the auto industry has actually been more consolidated to a few conglomerates that are able to set prices, because most people are just checking, what the price of a car is online, but little do they know, that feeds back to a more centralized price setting mechanism online to be able to source used car prices going forward. So to me, I think that the barriers have been established now for used car prices as another asset that is kind of a tiny bubble that we see everywhere, rising upwards over time.
Yeah, and it's really interesting how they're saying, some people are selling their 2013 Toyota Corollas and all these different cars for more money than they bought it, which is a crazy thing to think about in a deflationary asset.
Right, certainly. But I do think that as you look forward, Europe, there was always this big question, right? Back in the day, where was the U.S. going to lower interest rates to coincide with the monetary policies that were set in place by the EU, or was the EU going to have to raise interest rates to the level that the US was pre-COVID, right? I'm talking 2018, 2019. What we saw was the US actually, adopt the same, modern monetary theory and money printing policies that Europe had been implementing for many years before. And so we saw the US consolidate down in terms of interest rates to the EU. So I think going forward, if we're going to see interest rates rise, or maybe we're seeing these inflation pressures kind of percolate to the surface, I think the EU is going to be the leading indicator for that monetary policy change in terms of rising interest rates as well, similar to how it was with the falling interest rate regime.
That's interesting. So you think they'll be the first ones to obviously, raise their interest rates, and that might be a leader to the US.
Yeah. I mean, that's just my, personal opinion. But, I know that you are primarily in the space of, emerging markets, right? That's kind of your specialty, or?
Yeah.
Okay. Yeah. With, emerging markets, for me, when I look at the emerging market universe, I'm looking at it more from a geopolitical lens, and more along the lines of trade imbalances, right? So this goes back to that inflation narrative. In the U.S., we have a trade deficit, right? And what is a trade deficit? It just means that your trades or goods and services are getting imported more than what you're exporting out to other countries. So the U.S. for years has been running a trade deficit, and I think we're now at the tune of 1.4 trillion.
Yes.
Last time I checked. And when you run a trade deficit, there's a couple of things that are really important. One of the things that's important is how you're funding that deficit, right? Are you funding it with money that you have inside your own country? Are you printing money to do that? Or do you have foreign direct investment? And now it looks like the US is now trying to print their way out of their current account deficit, which is literally impossible to do. What you have to do is you have to build, grow, and produce more goods and services internally than what you're importing from other countries. So I think that the trade deficit, right, and having that litmus test of what's the parameter to be able to see changes in the currency is important to look at it from the lens of this giant trade deficit that you're having to build yourself out of. And if you're funding it in your own currency rather than a foreign currency, that makes it more difficult to do. And it may lead to this, inflation narrative lasting longer than just maybe a transitory time frame from what Powell is describing as maybe a year or more.
Yeah, definitely. And that's another one of those debates about whether they're, obviously the Fed are trying to sort of inflate their way out of a lot of the debt that they've sort of accrued over these last 15, 20 years.
Well, I'm interested to hear your side of that debate. What do you think?
I'm not too sure. I don't think they are. I think they're trying to, that they wouldn't mind if interest rates stay low, and then that they said what we're hearing from Yellen is she's sort of focusing more on the amount of interest being paid rather than how large the actual debt is. So I think that's sort of going to be the main focus of what they look at personally. So they're really just going to, if they're going to try to keep interest rates as low as possible for as long as they can to try and keep the interest they're actually paying quite low.
Certainly. And that makes sense, going back to those forward multiples that I was talking about, where price to cash flow right now, is almost 4 times what price to book is. That cash flow is of fundamental importance when you're looking at, valuations from a value lens or a value perspective. Can you cover your debt, interest payments, your interest coverage ratio? Do you have the cash flow that you need, and focusing less on revenue growth as a primary driver, or top line GDP growth as a primary driver for funding that out of that current account deficit. So it's interesting.
Yeah, I think it'll be interesting to see sort of how it goes. It's we can all predict, but obviously we don't know. Do you sort of have any other major macro events that you're focusing on, or things that you're watching out for?
No, I mean, if you're in the emerging market space, I think a big influencer for me is George Freeman. So he coined the term geopolitics, and he's wrote a couple of books, the next 10 years or the next 100 years. And if you take the basic premise of that book, he talks about the greatest opportunities and risks for countries, specifically going forward, have to do with their geopolitical makeup, right? So these emerging market economies, people have lived in them for literally thousands of years, right? They're not emerging by any sense in terms of their population. What it is it's adopting, and accommodating for their economies into a global infrastructure. And George Freeman talks a lot about who's able to have the best sort of uptake into that. If you look at Singapore as opposed to Vietnam, and their adoption into the global market economy is more of a litmus test for emerging market economies going forward. And that's just kind of a unique lens that I look at emerging markets in general.
Yeah, definitely. It's interesting because I actually had a fund manager from Vietnam, and he was saying that the stock exchange has only been open, I think, for like 25 years or something. So that's another thing that you look at the emerging markets, just as you said, the way they finance things. You look at the UK and it's hundreds of years compared to that 25. So that's why they're really mentioned as emerging.
Uh-huh.
Yeah.
Yeah. Right. Yeah. No, it's yeah, it's a good point.
Yeah, which is interesting. And in the US, are there any other sort of things that you're watching? Or so obviously you need to focus on the macro, but then would you more look at the cash flow of the individual companies?
Yes, yeah. So, the way that I construct a portfolio is made up of a concentrated basket of maybe 10 to 20 names at any one point in time. And when I construct that basket, I make sure to have the bull and the bear case scenario for every position that's taken. Make sure that they have stable revenue growth. Make sure that their operating margins are best in class, right? Typically above 30%. And that it's sector constrained as well, right? So you're not overloading in one value sector to be able to really diversify and bring that idiosyncratic risk to the forefront as opposed to market risk. And what I firmly believe right now is that idiosyncratic or company specific risk, buying good companies, often good boring companies, at fair relative value prices is more of a realist approach that we're going to need going forward than more of the idealist or growth stories that we've been told for the last 10, 20 years.
Yeah, definitely. That's interesting. And what would you sort of say is like, are the biggest mistakes that people make when, constructing a portfolio?
For me, so a couple of things, because I've been working on the portfolio management space for so long, right? I was a portfolio manager at Keats Conley. We managed $500 million in assets between the U.S. and Canada. I was the director of investment strategy at Pacific Capital. I managed $200 million in a broad basket ETF asset class breakdown structure. A lot of times, when investors would come to us and ask, hey, like, what are the 3 things that I should be doing right off the bat? The first one is know what you own. A lot of people don't know actually what they hold in their portfolio, or if they do hold it, maybe they're only hearing one side of the story. So knowing what you own is very important. Are you owning equity in a company? Are you owning a derivative contract? Are you owning a real tangible asset, or something that's just based on a cryptocurrency or a promise to deliver, right? So that's the first thing, is knowing what you own, and really kind of driving down to that first principle from the fundamental perspective. And having like that business mindset of if you were owning this company and you were running the company, right? What are some things that you would want to see in that company if you're going to hold it for the next 2 months or the next 20 years? So that's the first one, knowing what you own. The second is understanding the bull and bear case for every scenario. So what I mean by that is I often, will get so excited about a stock and really think through all the positive aspects, all the great things that could happen to this company going forward in the future and where it's at now. And then I spend less time where I kind of decrease the impact or negatively weight the implied probabilities of adverse scenarios, right? Because naturally, as an investor, you want to be an optimist. But the better you understand both the bull and the bear case for every position that you hold, the better and the more conviction that you can have to be able to successfully invest over long periods of time.
Yeah, definitely. That's a really good way to look at it, I think. And then sort of for yourself, if you look at the mistakes you've made and, maybe in the market or just in general, what have you learned from those?
Yeah, I think position sizing is very important. So you can hit a home run, right? One time playing baseball, right? If I use a baseball analogy, you can hit a home run and you can hit it one time. And then if you don't get any more hits throughout the rest of the game, you'll only score 1 point, right? But if you have, 9 batters up to bat and they all hit singles, you're going to be scoring 4 or 5 runs. during that same inning, right? So that's just, a naive sports analogy where I think a lot of investors initially want to come up to bat, swing for the fences, and hit home runs. But little do they realize that if you position size, in a smaller aspect ratio, you're able to hit more singles and you're actually able to score more runs over time.
Yeah, it's interesting. Was that from a mistake you made in the past where you maybe over leveraged or went a bit too big on a position?
No. I think the other is you can't just go up there and bunt, right? So for example, you can't go bunt and expect to earn runs as well. You actually have to hit singles or doubles to be able to successfully invest. For example, just recently in the commodities space. So we made an allocation to commodities in January of 2021. For the first half of the year, it turned out to perform very well, a broad basket of commodity futures. The problem is, if you're only allocating, 1 or 2% into commodities at that point in time, it's not going to have a meaningful impact on the portfolio as you would like. There's a limit to the upside potential based on your position sizes. So sometimes you have to have a higher level of conviction to be able to have a meaningful impact on the portfolio. So I'm generally a more conservative investor, right? And the approach often, leads to that efficient market hypothesis and being able to find, those optimal weights within a portfolio or an asset class. But if you want to have above market returns, you have to deviate from those asset class weights based on a historical look back period and start looking to the future. So you can have that vision of seeing the underpinnings of inflation leading into 2021. But then if you don't have that level of conviction to, allocate maybe 5 or even 10% of your portfolio, then you're not able to have as much outperformance relative to the market because you're only making, very small deviations.
Yeah, definitely. And how have you built that conviction? Because obviously it can sometimes be, especially if you've had a bad run or a bad trade, it can be quite hard to sort of trust yourself. So how do you do that yourself?
That's a good question. Well, how do you do that?
For me, I'm probably not the best person. I actually talked to someone recently who's his name's Darin Tuttle, and he focuses on like the mental sort of part of trading, and he's coached poker players and everything. And he says it's just having a strategy to understand your red flags and then sort of peel back the onions and actually say, okay, why is this happening? Why am I acting like this? What's happening? And then actually digging deeper. So if you sort of understand yourself completely, then you can have the conviction. I can't say something I have 100% down bags. Yeah. I'm still learning, but that's sort of what he said, where you have to understand yourself completely and understand, okay, what do I need to do to make sure that, this is going to work? I have my strategy. I know what I have to do. I know, if the numbers hit this certain reading, then okay, that's looking good. I just got to back it. Yeah.
And I think, one thing for me is, poker, I think, is great. A great teacher, right? It's going to give you that perspective of, putting real money at the table, and then also combining it with probability distributions, right? Or statistics. So having poker, right, as a kind of a teacher, a playground, and then having statistics and statistical analysis to be able to know how much and avoid that probability of ruin, right? Because you want to stay in the game, you want to keep playing, is a great teacher. My wife's a yoga instructor, so I actually do a lot of yoga or meditation, and getting in that rhythm or that sense of flow. So oftentimes when I'm taking a market pulse, when I'm seeing, different readouts from the portfolio, or I'm trying to get a sense of what tail risks look like at any one point in time, I'm updating my information I'm updating my probability distributions based on new information. Most analysts, would rather fail conventionally than succeed unconventionally, right? And so, when I see that, the price of an underlying changes and the information on the ground changes, then I'm able to update my expectations or probabilities going forward for that small basket of single names that I'm holding on a fundamental perspective. And then also on the volatility side as well, as the volatility surface changes, relative to its term structure, to the option prices, and as time to expiration changes over time as well. So updating those frameworks is critically important for me to be able to make sure that I'm staying within the risk parameters of the portfolio that's constructed.
Yeah, awesome. And there you sort of mentioned having that vision. And I think that's something that I've seen you mention before online, where you need to have sort of that vision of the future and, not just focus on the now. So is there anything else that you sort of see that are trends in the future, or that vision for specifically, the US?
Yeah. I'm going to use another naive, sports analogy, but it's skating to where the puck is going to be, right? So in hockey, right, you're trading, or like on the pitch for soccer, right? So if you just pass, where somebody is already at, you're going to miss them. So having that vision. So a couple of them is number one, I believe that volatility as an asset class is going to be mass adopted. That's the first one. The second is, I believe that we're in a period now similar to the mid 1970s, where there was a transition in energy and monetary policy. So the transformation in energy is related to decarbonization, but it also creates opportunities relative to renewable energy credits, right? Or the EU Green New Deal is creating opportunities to be able to trade kind of the second order derivative of this energy transformation from a financial engineering standpoint. So that's another really big opportunity is trading. In the US, we call them RECs, right? Or RECs. That market is going to explode over time. And then the third is related to cybersecurity. And I've mentioned this in my newsletter, where cybersecurity is not going away. And the investment in technology and the fact that technology disrupts has created a disruption in terms of having a secure network and being able to work remotely and do that securely. So I think that going forward, investing in good cybersecurity companies is becoming a priority of executive management, and it's going to have a greater significance going forward. When I talk about technology disrupting, right? If you think about in 2004, the market for ringtones, right, was a $6 billion industry. I remember buying ringtones, right, on my little Nokia phone. And I would wonder what the market is now for ringtones, right? It's essentially zero.
Yeah. So
you had a $6 billion industry go to zero over 2004. So, 16, 15 years. That's incredible. So, 5 years from now, there may be a market that we have no idea about. And understanding that you need to be dynamic to what's around you and open to new opportunities is, I think, also critically important as well.
Yeah, definitely. And would you sort of focus more on the technology side then? I guess you're in California, so it's a good place to be. Is that what you do? You sort of look at new innovations that are coming through and maybe new companies, or how would you do that?
I get a lot of my ideas from others. So I spend a lot of time on Twitter, FinTwit, listening and talking to people there. I think finding a great investment ideas also takes you believing in it before anybody else does. For example, one of the core positions in my portfolio is Biogen. The ticker is BIIB. We initiated a position in it in the beginning of January of 2021, with no expectation about where the Alzheimer's drug development process was going to be in terms of FDA approval. And it just so happened that because they have the cash, because they have operating margins in the 80%, because they have the relative value to be able to apply to research and development, they brought this drug, out on a great, one-day announcement, and the stock shot up 34%. So you can even, make an investment on something based on some sound fundamental principles. And because you're in the right place at the right time, you're able to participate in that upswing as it needs to be, or as it happens.
Yeah, definitely. Well, that's pretty good position there. So you sort of talked about volatility as well. So when you say trading that, is that like VIX and sort of other sort of ways to trade volatility? Is that what you suggest there?
Yeah. So where do you want me to start with that? Because coming from my perspective on trading volatility can be somewhat different for how you're looking at things going forward, because the past of what volatility has looked like in the markets for volatility and trading volatility and using it as a profit mechanism and a tail hedge is somewhat different in its construct to what is going to be forward, namely very esoteric, institutionalized, over-the-counter products that were limited to a few main players, is now getting democratized to the masses. So I say that and I take a breath because that can go in a variety of different directions.
Yeah. So do you want to start from the beginning? So for me, I really only know, as I said, just trading VIX and that. I don't really know too much more about sort of trading volatility. So maybe you want to start from the beginning and maybe the future of where it's going to potentially be able to go and what people will be able to do in the market.
Yeah, I think, from its most basic perspective, options and trading, that optionality is able to give you asymmetric payoffs, right? And then when you trade an option, you have different types of risk, right? You have your delta risk, right, which is your price sensitivity to that underlying. And then you also have your vega, right, which is your price sensitivity to changes in implied volatility. Well, if you just talk about the principles of trading volatility, right? So volatility is mean reverting. Volatility is able to have a negative correlation to equities, and volatility, in some senses, has a path dependency or a serial correlation, meaning that yesterday's volatility, depending on the strategy that you're using, has somewhat of an impact of what volatility will be tomorrow. And so those three aspects of volatility, and specifically isolating that exposure, that vega exposure, is where you're able to have convex payoffs or make large gains when the market drops a lot. So, for example, if you're just trading straight vega, right, or the price change relative to implied probability, you can be able to reflect that just in option prices. So if you think that the price of something is going to go down, you can buy a put option with a 10% buffer or 10% out of the money, or you can buy what's called a doomsday put, where you're buying an option that's 30% out of the money on a stock dropping. And what the research has showed is that actually, if you're buying a stock put option at a 30% out of the money, or a doomsday put, that if the price of that stock drops, the value of your put option at the 30% level increases, but it also does something else. It actually steps on the gas pedal, and it actually increases in value at an accelerated rate relative to your 10% or 10% out of the money put option. So just that, just in its purest sense, it means that when you need, a hedge, the lower option prices actually have the greatest level of protection, or the greatest level of price appreciation when you need it most. And that's what's called Volga. So when it's like a second order derivative of that first order derivative of Vega. And then that's where, option strategies can blow up. That's where you're able to be able to make money on those relative price differentials or relative value differentials between different asset classes. And then you're also able to hedge your bets across the board. So in its purest sense, buying out of the money put options on a company is a good tail hedge risk, but it also has that cost of insurance. And then to be able to offset that cost of insurance, you can offset that with an option on that same company, or you could go out into the market and find other offsetting costs to be able to reduce that insurance premium across other asset classes as well. So in its purest sense, trading volatility or trading a volatility overlay, in the sense that we implement it, is we look at those interrelations between asset classes on a broad-based index, and then we look to hedge that exposure or reduce that insurance premium with other cross-asset correlations.
Yeah, well, that's super interesting, because I guess in the UK, and it's fascinating. In the UK and Australia, we sort of have CFDs. So, if you want leverage, you don't have to go sort of the option route. You can just basically, it's like a long or a short. But yeah, that's interesting how you're saying that even if it's more out of the money, it's obviously less chance for it to actually the contract to sort of expire in the money. You actually might be better to take that, because there's more, there's more upside in the short term if the price goes the right way.
Right, and specifically, if you isolate, volatility as your exposure, then you don't even have to have that option expire in the money to be able to make a relative value gain or a profit from trading volatility. So the short answer is, if you isolate those mechanisms from an options perspective, there's, people buy options for many different reasons, right? From the big players to the small players. If you're in a war, and you have tanks, and you have, assault vehicles, and you have, aircraft carriers, and then there's somebody out there with just a bow and arrow, they're able to kind of avoid or stay away from, some of those bigger players, and be able to be effective, in the battlefront, because they're just playing by a different set of rules, and that's what happens when you're trading relative volatility strategies.
Yeah, definitely. So you're not even trading the value of the company in general. As you said, you're just trading the volatility.
Yeah. And I think that's where you have to go back, and you get grounded into buying good companies at fair prices, and then building on that to be able to enhance returns, right? This is a return enhancer. It's not always on in the portfolio, and so it's limited in its use case, but it's there when you need it, which is most important.
Yeah, it's just like another tool in your arsenal that you can use to maximize returns.
Yep.
Perfect. So yeah, thank you so much, Darin, for sort of joining the podcast and talking to me. I'd just like to ask my last question. So what is one message you'd like people to sort of take away from our chat?
Just like one thing?
If you have a few, that's okay.
No, I mean, I think going back to that principle that risk can't be eliminated, but only transformed, right? So understanding your trade-offs and being able to price those trade-offs in the right sense is the most important thing for successful investing going forward. And I think that if you can take that and think about the world in terms of trade-offs, that you'll be a much better investor going forward.
Yeah, awesome. Great advice. So if people wanted to get in contact with you or get in contact, what would be the best way to do that?
Yeah, so you can visit my website at www.tuttleventures.com, or you can find me on LinkedIn, Darin Tuttle, DarinTuttle, or you can find me on Twitter as well. I'm on there at Darin_T80. That's me. So.
All right, perfect. So yeah, Darin, thank you so much for joining us.
All right. Thanks, Tony.
Cheers.